Welcome back. It's time now to take a look at the top business stories. Moody's upgrades DP World to investment grade with stable outlook. UAE accounts for two-thirds of Gulf region's M&A deals in the first quarter of this year. And India's government serious about eradicating corruption. Let's look at the equity markets first. The UAE bourses both edged higher today. Dubai's DFM General Index gained 0.2% to close the session at 1,573 points. Best performing sector was the insurance sector, with Islamic insurance companies Takaful Emirate and Takaful House both rising more than 10%. Other stocks to watch are DP World, which was up 1.6% after Moody's raised the rating of the port's operator to investment grade. And Shua Capital rose 4.4% to a two-month high after the United Arab Emirates' biggest investment bank said the Tunisian Financial Market Council lifted the freeze on its brokerage accounts. 262 million shares were traded, valued at 247 million dirhams. And over in the capital, the ADX index gained 0.4% to close at 2,619 points. All three on the ADX-listed real estate companies were down: Alder Properties by 0.7%, Suru Real Estate by 1.5%, and RAK Properties by 2.5%. Dana Gas was down 1.5%. The banking sector was mixed. Best performer was National Bank of Fujairah with a plus of 10%, while Abu Dhabi Commercial Bank lost 1.9%. Index heavyweight Etisalat was up 0.5%. 62 million shares were traded, valued at 122 million dirhams. And now let's have a look at the GCC markets, which ended mainly higher today. It was a turbulent week in the currency and commodity markets last week. Also, gold and silver posted new highs of over $1,474 a fine ounce for gold and $40.92 for silver. To talk us through the movements in the currency and commodity markets, we are now joined by Gaurav Kashyap, head of DGCX trading at Alpari Middle East DMCC. Welcome to the show, Gaurav.
Thanks for having me, Linda.
Let's talk about the dollar first. The US dollar index fell to a 17-month low, and that despite a bunch of bad news out of Europe. Portugal is the next domino stone to fall after Greece and Ireland. What do you think? What does the currency market hold for us this week?
Linda, it was a very curious time in the currency markets last week. Despite all the negative risk-related events, we didn't see any type of risk sentiments eroding. And as a result, we saw the euro, as you said, reach a 30-month high. We saw GBP also rallying past 164 levels. The commodities also really took a big boost. And this is mainly because the FOMC meeting minutes were perceived to be they weren't very impressive with regards to future rate hikes from the Federal Reserve Bank. And as a result of that, speculators, investors piled on the longs against the US dollar, and we have the dollar trading at, as you said, the 17-month low we have it at today. I think what we're looking at this week is probably a focus shift towards more about what's happening with the EU and their sovereign debt crisis. Now that the interest rate decision from the ECB is firmly in the rearview mirror, we can focus more on the developing story coming out of Portugal. We do see that the markets are extremely overbought against the US dollar, which would mean that we're expecting to see some kind of correction this week. We can probably expect to see the euro moving down towards 142.40 levels. Another point that we need to look at this week is the GBP. We have a lot of data coming out of the GBP starting tomorrow with the CPI data, which should be a little higher than expected, which should help the GBP rally probably up towards across 165 levels.
There was something interesting with the Aussie dollar against the US dollar. It reached an all-time high, didn't it?
The Aussie dollar absolutely reached an all-time high. The Aussie dollar has been very, very supported by higher commodity prices. Despite the rate hike by the Chinese government last week, we did see the Aussie move to that all-time high. Now, these rate hikes by the Chinese government, they are continuing to have a less and less impact on the currency markets, and the Aussie has been a terrific beneficiary of that.
So let's look at crude oil a bit. Oil reached a 30-month high, and also gold and silver has seen a strong upward momentum. What can we expect from those two, oil and gold and silver?
Well, Linda, to tie it into the first question, because we're expecting to see some kind of dollar profit-taking coming into place, we are expecting to see some kind of reprieve in the commodity prices also this week. The commodity prices continue to linger higher, mainly on the back of the instability engulfing Libya. Now, there was news about of an African Union delegation headed by President Zuma heading to Libya to try to thrash out terms of a ceasefire. Now, as soon as we got news that Gaddafi was willing to accept such a ceasefire, we saw the crude immediately correct a little bit. So once again, I think we should see probably a lower prices in the commodity segment this week, and probably we can look at 106 in the crude, and we can probably see gold staying in a range between 1440 and 1480 with a move towards 1440 likely.
So it's not a good time to go buy gold at the moment, isn't it?
No, we'd wait for a while.
So thanks for coming in today.
Always a pleasure.
See you next week. Wonderful. And now to our top stories. Rating agency Moody's raised DP World's credit rating to investment grade from junk, as the government-controlled ports operator managed a rapid recovery of its performance. The long-term foreign currency and local currency debt ratings, which affect $3.3 billion of debt, were lifted one notch to Baa3 from Ba1, Moody's said in an emailed statement today. The outlook is stable. It is based on Moody's expectations that DP World will maintain its position as a global leader in port operations, as well as stay within its boundaries of its leverage target by avoiding large acquisitions. The sale of the company's Australian assets worth $1.5 billion will also help reduce debt and is therefore seen as credit positive, Moody's said. The UAE accounted for 66% of the Gulf region's M&A deals in the first quarter of this year. According to a merger and acquisition report by research firm Sapphire, 119 transactions worth $3.6 billion were made in the Middle East in the first 3 months of this year. The UAE accounted for the bulk of deals, with Centurion Investments buying a 40% stake in UAE-based NMC Healthcare worth $1.1 million. The deal accounted for 30% of the total value of deals in the Middle East. According to Sapphire data, the value of M&As in the Gulf region weakened 22% from $4.6 billion in the fourth quarter of 2010 and was 60% lower than the $9 billion recorded in the first quarter of 2010. The Abu Dhabi Securities Exchange is positive that it will achieve emerging market status this year, according to the company's deputy CEO. Rashid Al-Belushi told a local newspaper that the ADX has met most of the MSCI's requirements to be able to receive the status. MSCI said in June of last year that it is keeping the country under review for reclassification. So far, the MSCI sees the UAE as a frontier market. Becoming a member of the MSCI emerging market family is vital for a stock market to increase liquidity because the indices are tracked by many international investors. So far, an estimated $5.2 trillion flowed into emerging markets equity. And in our fast financial news, car sales are rising across the UAE off the back of easier financing. Companies such as US car maker General Motors have recorded a 40% surge in sales in the first quarter of this year compared to the same period last year. Officials account this to a decrease in rejection rates for financing, which has fallen by half from 2009 levels. In the year 2020, Dubai could jump up the rankings from the 32nd to the 11th most influential city of the world. That's according to a new report released by property company Knight Frank. New York and London are expected to remain on top. And net foreign investment into Jordan Stock Exchange in the first quarter of this year rose by 44 million Jordanian dinars. That's 227 million dirhams. That compares to only 3.9 million Jordanian dinars, or 20 dirhams, during the same period of last year. And after the break, we will run you through what's making the headlines in international business today.